Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week, stocks to watch, economic news to highlight. I was reminded of something my mom used to always say this week. She used to always use the popular phrase, in the pink, right, to describe herself as cheerful and healthy. And the phrase came back to me, not just because my wife is itching to see the new Barbie movie, but because it feels like the stock market is in the pink too, right? Inflation has come down just enough that it seems like this week's Fed meeting is going to be the last interest rate hike. And they might even be able to start lowering rates by early next year. The jobs market is still strong enough to support economic growth. And so far, investors have taken the declining year-over-year earnings all in stride. Not everything is in the pink, though. In fact, researching exchange-traded funds, or ETFs, this last week, I found one that is anything but what it seems. It reminded me that investors always need to question the consensus, that conventional wisdom, and do their own research. I'm going to expose that $25 billion lie in this one ETF next in today's main topic. Stick around after that. We'll do our stock market update, stocks to watch this week, and economic news you need to see. First, though, a lot of you in the Bowtie Nation know I started posting analysis on Seeking Alpha back in 2009. It was one of my first paid analysis jobs, and before I became a professional analyst. Since then, I still follow a few of the analysts. I still use the stock screener, and it's just made some big improvements to the stock comparison features that makes it easy to pick stocks. In fact, it's one of the few research tools I use every single week. Now, most of the best features are only available with premium access, but you can now try Seeking Alpha absolutely free for 14 days with the link I'm going to leave in the description below. Click on that link below, try out Seeking Alpha for free for 2 weeks, and check out some of these features that I use. You're going to get access to the best articles and analysis. Now, the free analysis posted can be hit or miss sometimes, but that premium content is really good. Listen in on the company earnings and conference call recordings. You're going to find all the stocks with the best payouts, and one of my favorite tools here, the dividend forecast tool, shows you actual forecasts of how much in dividends you're going to collect from each stock over the next 2 years. So again, check that out with the link below. Absolutely free 2-week trial to Seeking Alpha Premium Access. I want to get back to our main topic though, because this iShares S&P 500 Value ETF, the ticker IVE, has had a great year. It's up 15% in just the last 4 months. It's a $25 billion ETF, and really supporting the idea that with those higher interest rates, value stocks are outperforming. But the stock is not what you think. In fact, it might be kind of lying to investors. Now, the definition of a value stock is just one with a lower valuation multiple, right? Usually price to earnings, so PE ratio, other metrics like price to sales, price to cash flow. It's just a lower PE means that investors are being required or paying less in share price per every dollar in earnings, right? The price per earnings. So, for example, a stock with a price of 15 times its earnings, it's trading, if it had $1 in earnings over the last year, trading for $15, right? 15 divided by the earnings, 15 to 1. Okay, 15 times price to earnings. That would be a better value than trading for maybe 20 times price to earnings, because investors have to pay 20 times what the company made in earnings over the last year. That's the PE ratio, the price to earnings ratio. And now I have to say better value, right, in finger quotes, because you can never take the valuation, and value stocks shouldn't be looked at in isolation. Okay, you can't simply say that a stock with a PE of 15 is better than a 20 PE just because it's a lower valuation. Okay, if the stock with 20 times PE ratio is growing sales at twice as fast, then yeah, there's a reason why it's more expensive and a better value, even at that higher valuation. Okay, I'd be willing to pay more for every dollar of earnings. I'd be willing to pay $20, a share price of $20 per dollar of earnings, than for that faster growth rate versus the 15 PE stock, just because it's growing so much faster and it's eventually going to grow into those earnings and produce a higher return. But then that idea of value investing, looking for the cheaper stocks, does have some merit, and it's the idea that the valuation premiums on those higher price stocks just aren't justified. Okay, that stock with the 20 times price to earnings ratio, the 20 times PE, is 33% more expensive than the 15 times PE stock. Okay, if sales or earnings growth are just only marginally better for that stock, or if they even come down for that higher price stock, then over time, that lower PE ratio, the cheaper stock, is going to outperform on returns. And that's what value investors are looking for. But back to this value ETF, the IVE, and why it's important here, or why it's done so well this year, and why investors may want to think twice, why it's not all that it seems. Within the top 10 stocks held by the fund. And you can always find this by going to the ETF's website and looking for holdings, which I'll show you later, or just on Yahoo Finance and going to holdings here and clicking on this. If you go to holdings, Scroll down, it's going to show you the sector weighting, so all the sectors in the fund are represented in the fund, any bonds, but then it's going to show you the top 10 holdings, the top 10 stocks in the fund, as well as the percentage of assets, the fund assets in that single stock. And if you look here, we find shares of Microsoft, Meta Platforms, so the old Facebook, Netflix. Now these three stocks alone account for 11% of the fund and have produced an average 48% return so far this year. So really propelling those shares skyward. Now for some of these, you could make the case that Meta Platforms was a value stock. We're here in the statistics tab in Yahoo Finance for Meta, the old Facebook there, and you look at the trailing PE, so that price to earnings ratio, now at 36 times. But it was at one point last year when it was hitting rock bottom, down to about 11.5, 11 and a quarter. So you could make the case that that was a value stock last year. So I'm willing to give that one a pass. But here we are on Netflix here, and it's rarely been under 20 times on a price to earnings ratio, right? You see here the last year, it's right now at a 45 times price to earnings. It's only been down to about 21 times price to earnings. It was down to 15, 16 times price to earnings back in June of last year. But then if we look at Microsoft even, Microsoft has not even cracked 20s. It's down to as low as 24 times price to earnings. It's now as high as 37 times price to earnings on that price to earnings ratio. Amazon, also in the top 10 holdings there in the fund, only made it down to 51 times price to earnings in last year's sell-off, and now trades for over 300 times on a price to earnings basis. Now the problem here seems to be how the S&P, so Standard & Poor's, is designing these rules for what stocks go into what classification, value versus growth versus, whatever in their indexes. And then of course, the funds, the ETFs that track those indexes seem to be defining value stocks by subtraction. Okay, it's not really looking for value stocks. It's just looking for, stocks that it's a catch-all for stocks that don't fit into its other classifications like growth stocks. Okay, the rules for what it called growth stocks changed back in 2009 to include momentum. Okay, making one of the growth index qualifiers is that a stock price was increasing over a period that had that upside momentum, and that made it a growth stock, right? Now, that meant that even a lot of very high priced, not value stocks, so stocks trading at very high price to earnings ratios versus their peers, last year could not be classified as growth stocks because of their falling stock prices. So you had a lot of stocks last year like Facebook, like Netflix, that really saw steep sell-offs, lost that momentum classification and that growth stock classification, and they had to be bunched in with value stocks then, because if they're not growth stocks, then they must be value stocks, right? That was the rationale for Standard & Poor's and how it got into some of these value stock funds like the IVE. Now, the lesson here really isn't value versus growth or whether this fund is doing something that it shouldn't be doing. It's just that you need to understand what's in your ETF. So rather than just take the fund manager's word for it. For example, we can go to the ARC-X, right? The ARC Space Exploration and Innovation ETF. Go down here to holdings, and this is how you find the holdings, more than just the top 10 stocks for any ETF. You can go to holdings, go to download a CSV file or a PDF file. We'll download the PDF file here for the ARC-X Space Exploration ETF. And for the love of God, can anybody tell me why shares of John Deere, ticker DE, are in a space exploration ETF? Are we farming space now? Now, one or two weird choices in a fund don't make it a bad investment, but it is a decision you need to make after looking at what's actually in the fund. Again, you can see the top 10 holdings for a fund on Yahoo Finance. You can go to the fund's website and see all the holdings. What you need to decide is here that after looking at what's in there, how closely is it targeting that target theme? Okay, because presumably if you're investing in a value ETF, it's because you prefer value stocks. You want that exposure versus growth stocks or some other theme. Is it truly a space exploration fund or a value fund that you're actually buying? So are there so many other stocks in there that don't fit with that theme that it's not really giving you that exposure? And is there something out there that is a better choice, more targeted toward that theme? For example, here, the Vanguard Value Index Fund, the ticker VTV. While it does own shares of Meta Platforms, it doesn't have a lot of these other questionable value stocks you find in that iShares fund. If you look here, it's all United Health, Exxon, Johnson & Johnson, Procter & Gamble, Merck, a lot more, that value targeted fund. So please, when you're looking at ETFs for that core part of your portfolio, that core satellite strategy that we talk about so much here on the channel, make sure that it's actually doing what it says it's doing. Okay, what's in the fund? How does that fit for the rest of your portfolio? And is it going to be a good investment for what you're looking for? I want to look at some of the stocks I'm watching this week. Going to be a huge week for earnings. Lots of companies coming out with their reports. Could be very volatile around those stocks. One here, Teladoc Health, ticker TDOC, is going to be reporting its earnings on Tuesday, with the shares really going nowhere this year, despite some very favorable news pushing the stock higher temporarily at times. We saw a big pop in the shares on an expansion into weight loss management earlier this year, and then an expanded partnership with Microsoft in AI last week, but those all quickly evaporated. Earnings comparables, though, are going to be very easy this year versus the massive write-downs we saw last year. 9% sales growth expected should continue to move this stock in the right direction, and I continue to hold it. I think the growth is going to come back and push this stock higher. Also going to see a lot of real estate stocks, REITs like American Tower, ticker AMT, and here gaming and leisure properties reporting their earnings this week. The entire sector here, real estate sector, is down over the last couple of years on that rise in interest rates. I'm going to be doing a live stream video tomorrow at noon Eastern to show you how to pick the best REITs for what I believe will be a 2024 rebound. A lot of these real estate stocks down hard on that interest rate rise because the properties are so leveraged, with rates expected to start coming down and values falling this year. Could be the perfect time to start investing in this theme. Another sector I'm watching, oil here, and Chevron Corp, ticker CVX, going to be reporting its earnings on Friday along with ExxonMobil, with the shares down 8% this year and really flat since May. Most energy stocks have lagged the market despite the price of oil jumping back to the top of its range recently near $77 a barrel. A higher oil should start showing through in oil company cash flows as well as dividends and could raise these shares pretty quickly. Give you a big picture idea with the sectorspiders.com, their sector tracker. Great way to see how the sectors of the economy are doing. We did see 9 of the 11 stock sectors close higher last week, though not all was it appeared here either. Okay, the sharp drop in stocks and communication services and consumer discretionary. Okay, both of these sectors down over 2%, well underperforming the market. Really a factor of just a couple of companies, in fact, 4 companies within these sectors. Within consumer discretionary, you got 2 companies, Amazon and Tesla, are 42% of the sector, just because the S&P 500 is market weighted, so the largest companies carry a bigger weight in that index. And within each sector here, you've got Amazon, 23% of the consumer discretionary sector was down 3.5% last week. Tesla, almost 20% of that sector, was down 7.5%. Outside those 2 stocks, 31 of the 53 companies in the discretionary sector did close higher, so there might be a little bit of optimism here without just those 2 stocks. In the communication services, Meta and Alphabet make up 36% of the sector and fell as much as about 4.5% each, and more than half of the stocks in the sector. 14 of 23 stocks in the sector did close lower, though, so it's a little bit more broader weakness than we saw in consumer discretionary. Together, though, with these 4 stocks, Meta, Google, Amazon, and Tesla, dragged the S&P 500 down almost 0.5% last week. So it was up 0.69% last week, the entire index. Without just these 4 stocks, though, it would have been much more robust, 1% higher. We did see a very strong rebound in the regional banks, though. Big winners last week with 8 of the top 10 stocks in the entire index in the S&P 500 from the financial sector. Most of those hardest hit from last March saw big bounces. Zions Bank Corporation, ticker ZION, was up 17%, more than 17%. Charles Schwab Company was up 14% last week alone. The overall group still in the red here. Want to show you a year-to-date chart with the SPDR S&P Bank ETF, ticker KBE, in red, down 10.8% so far this year. The SPDR Regional Bank ETF, ticker KRE, here in purple, is down 20% for the year still, even after last week's big run up in prices. If we are seeing some kind of healthier balance sheets, some kind of rebound in these banking stocks, which I believe once interest rates start coming down, you're going to see a lot of the balance sheets improve for these regional banks. You're going to see deposits start coming back, and I think it's going to continue that rebound in these shares. The big news this week, of course, is going to be the meeting of the Fed on Wednesday and what is expected to be its last interest rate hike this cycle. I'm going to show you the CME Fed Watch tool. It's a great resource to see what the market is expecting as far as interest rates from the Fed to come. Now, the consensus here, if we scroll down, the meeting is in 3 days. Here it's on Wednesday. Wrapping up on Wednesday, they're going to report their interest rate hike. The Fed funds rate current target is 500 to 525. Okay, that's basis points, so it's 5% to 5.25%. Next meeting here on July 26th. And the market expectation right now, 99.2%, that the Fed will raise interest rates by 0.25% when they wrap up that meeting on Wednesday. Okay, so it's going to be a new current target for the Fed funds rate of 5.25 to 5.50, up as high as 5.5% interest rate. And a really interesting way to look at this, if you go to probabilities here and you go to meeting probabilities, and if you look in blue here is the market expectations for where rates are going to be over the next year. The market is putting better than 50% odds that the Fed has kept rates as high as 5.5% through January of next year. But by then, they start believing the Fed rate cuts will start coming. Market believes next move is lower in March, with its rates as low as 4.25% by end of next year. So if we do get rates down to 4.25% by the end of next year, that would be a huge move. 1.25% rate cuts from the Fed in just a year. That would be a big change in a lot of the stocks, a lot of the companies that have been hit hardest by those interest rate increases. We're talking real estate stocks, since real estate is very highly leveraged. As those rates come down, those property valuations are going to get better, and we're going to see a big rebound in those REIT stocks. Banks. We've seen the big sell-off in banks, and that crisis this year was because interest rates rose so much. The bond portfolios that the banks were holding were devalued because of those higher interest rates. Once rates start coming down, those bond portfolios are going to start going up again, and I think you're going to see a big rebound again in these bank stocks. Another big economic data point coming out this week, we're also going to see data on new home sales for the last month, with expectations for 717,000 new homes sold. Now that would be a further drop from 763,000 in the prior month, but there is reason to believe that home builders may see better times ahead. So anyone building homes in this kind of environment, with more than half of homeowners locked into interest rates below 5% on their mortgage, there's no incentive to sell their house or move if they're just going to have to take out a mortgage at 7 or 8% now, right? So you've got a huge portion of the market that is not selling their homes, not putting their homes on the market. That's keeping available homes for sale at multi-decade lows. And it seems until rates do come down significantly through next year and even beyond that, the only way out of that problem, out of that housing shortage, is going to be to build new homes. So that's why I say, even though the mortgage industry is still going to be hurting because of higher interest rates, even though a lot of interest rate sensitive stocks are going to be hurting, those home builders could still do very well because they're having to build us out of this housing shortage. Look for that link below and try out Seeking Alpha Premium Access for 2 weeks absolutely free. Or click on the video to the right for the fastest way to live off your dividends. And I guarantee this is not what you expect. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.